Are you tired of the constant ups and downs in the stock market? Do you find it challenging to keep up with individual stock performance? If so, you might be wondering if there's a better way to invest. Have you considered switching from stocks to ETFs? In this video, we'll dive into why many investors are making the switch, the benefits of ETFs, and how they can provide a more stable and diversified investment strategy. Whether you're a seasoned investor or just starting out, stay tuned as we explore how ETFs can simplify your investment journey and potentially boost your returns. What are ETFs? Let's start with the basics. What exactly are ETFs? ETF stands for Exchange Traded Fund. Think of an ETF as a basket of various assets, stocks, bonds, or other securities that you can buy and sell on the stock exchange, just like a regular stock. Unlike mutual funds, which are only priced at the end of the trading day, ETFs are traded throughout the day at market prices, giving you the flexibility to buy and sell at your convenience. The benefits of ETFs over individual stocks. Diversification. One of the biggest advantages of ETFs is diversification. When you buy an ETF, you're investing in a broad range of assets rather than putting all your money into a single stock. This diversification helps spread risk. For example, if one company in an ETF performs poorly, it might be offset by better performance from another company within the same ETF. Lower costs. ETFs typically have lower expense ratios compared to mutual funds and other investment vehicles. Since they often follow a passive management strategy by tracking an index, they incur fewer costs in terms of management fees and trading expenses. This means more of your money stays invested, working for you. Flexibility and liquidity. ETFs provide the flexibility to trade throughout the trading day at market prices. This intraday trading capability is particularly beneficial during volatile markets, as you can quickly react to market movements. Additionally, the liquidity of ETFs, supported by their ability to be easily bought and sold, ensures that you can enter or exit positions with minimal impact on the price. Transparency. ETFs are known for their transparency. The holdings of an ETF are usually disclosed on a daily basis, allowing investors to see exactly what assets are in the fund. This level of transparency helps you make informed investment decisions and understand the underlying assets driving your ETF's performance. Common types of ETFs. Now that we've covered the basics and benefits of ETFs, let's look at some common types of ETFs available to investors. Index ETFs. Index ETFs track a specific index, such as the S&P 500. They aim to replicate the performance of the index they follow, providing exposure to a broad market segment or sector. Sector and industry ETFs. These ETFs focus on specific sectors or industries, like technology, healthcare, or energy. They allow investors to target particular areas of the market that they believe will perform well. Bond ETFs. Bond ETFs invest in fixed income securities like government, municipal, or corporate bonds. They provide a way for investors to gain exposure to the bond market without having to buy individual bonds. International ETFs. These ETFs provide exposure to markets outside of your home country. They can be broad, covering multiple countries, or specific to a single country or region. Thematic ETFs. Thematic ETFs focus on emerging trends or themes, such as clean energy, artificial intelligence, or e-commerce. They offer a way to invest in innovative sectors that are expected to grow significantly. Why switch from stocks to ETFs? So why should you consider switching from individual stocks to ETFs? Here are a few compelling reasons. Reduced risk through diversification. When you invest in individual stocks, your portfolio's performance can be heavily influenced by the success or failure of a few companies. ETFs mitigate this risk by spreading your investment across multiple assets, reducing the impact of any single stock's poor performance. Simplified investment process. Managing a portfolio of individual stocks requires constant monitoring and research. ETFs simplify this process by offering a diversified portfolio in a single investment, reducing the need for frequent adjustments and in-depth analysis. Cost efficiency. With lower expense ratios and reduced trading costs, ETFs can be a more cost-effective option compared to building and managing a portfolio of individual stocks. This cost efficiency can lead to higher net returns over the long term. Access to a broader range of investments. ETFs provide access to a wide range of asset classes and markets that might be difficult or expensive to invest in individually. This includes international markets, specific sectors, and unique investment themes. How to transition from stocks to ETFs. If you're convinced that ETFs might be a better fit for your investment strategy, here are some steps to help you transition from stocks to ETFs. Assess your current portfolio. Start by reviewing your existing stock portfolio. Identify which stocks you might want to sell and consider any potential tax implications of selling those stocks. Set your investment goals. Clearly define your investment goals. Are you looking for growth, income, or capital preservation? Your goals will influence the types of ETFs you choose to invest in. Research and select ETFs. Conduct thorough research to identify ETFs that align with your investment goals and risk tolerance. Consider factors such as the ETF's performance history, expense ratio, underlying assets, and the reputation of the fund manager. Create a diversified ETF portfolio. Build a diversified ETF portfolio that includes a mix of asset classes, sectors, and geographic regions. This diversification can help spread risk and enhance potential returns. Implement a phased transition. Consider transitioning from stocks to ETFs gradually. This phased approach can help manage potential market volatility and tax implications. You might start by selling a portion of your stocks and reinvesting the proceeds into ETFs over a period of time. Monitor and rebalance. Regularly review your ETF portfolio to ensure it continues to align with your investment goals. Rebalance your portfolio periodically to maintain your desired asset allocation and take advantage of market opportunities. Common misconceptions about ETFs. As with any investment, there are some misconceptions about ETFs that might make investors hesitant to make the switch. Let's address a few of these. ETFs are risk-free. While ETFs offer diversification and can reduce risk, they are not risk-free. The value of an ETF can still fluctuate based on market conditions, and you can lose money. It's essential to understand the risks associated with the specific ETFs you invest in. All ETFs are the same. Not all ETFs are created equal. There are significant differences in terms of their underlying assets, investment strategies, and management styles. It's crucial to research and select ETFs that fit your investment goals and risk tolerance. ETFs always outperform individual stocks. ETFs generally provide more stable returns compared to individual stocks, but they may not always outperform individual stocks, especially high-growth stocks. Your investment strategy should consider both the potential for stable returns and your risk tolerance. Switching from stocks to ETFs can be a strategic move to achieve a more diversified, cost-effective, and stable investment portfolio. ETFs offer numerous benefits, including diversification, lower costs, flexibility, and transparency. By understanding the different types of ETFs and following a structured approach to transition, you can simplify your investment process and potentially enhance your returns. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more investment tips and strategies. Leave a comment below if you have any questions or if there are any topics you'd like us to cover in future videos. Happy investing!